Another episode here with Ryne Williams. Thanks to you all. Ryne and I wanted to just get back on here almost on a weekly basis just to open up our chats to you all. So, Ryne, I'm just going to go ahead and throw it over to you, man. What's been up on the week? What have you been thinking? What have you been doing?
So right before we went live, I told Ari I've got some thoughts. I've got something I've been thinking about this morning, and I don't know what it is about today, but I've gotten, and I'm not exaggerating, I've gotten 5 or 6 different comments referencing, across different videos too, from different people, referencing stocks like AGNC and ARR, which is Armor Residential REIT, and ORC, Orchid Island Capital. And these comments are just referring to people buying them or owning them, and how much income they're getting from these various positions. And in case you've never heard of any of you guys in case you guys haven't heard of any of these companies before, they're all big fat yield traps. Okay, all of these, if you look at the dividend history on all of these stocks, over time that dividend per share is going down. And I think, I could be wrong about this, but I think in all of their cases, actually, if you look at the dividend per share 10 years ago to the dividend per share that's being paid out today, it's been more than cut in half. And that trend is going way down over time, which is obviously the exact opposite of what you should be looking for. But like I was saying, I don't know what it is. I don't know what's going on today. But I don't know. I guess I'm still, and Ari, I know you've done this too. I feel like we've both, over these years, really maybe I'm going to trip over my words a little bit, but I think we've really done we've really tried to put it out there that you shouldn't invest in those type of things, those things where you look at the dividend history and it's going down over time. But still, man, I guess what I'm thinking is I still feel like there are so many people who invest in those types of companies, and I'm not saying this to try and criticize or be disparaging or anything like that. It's just something that I'm trying to understand, because I don't. And I guess in my mind it seems like, and maybe that's the difference. This is just the way I think versus the way other people think. It I don't know. It just feels so, to me, it seems so straightforward to just, and simple enough to just look at the dividend history, see it go down, and decide, that's probably not a good one. But I don't know. I guess I'm surprised that those type of companies still, after all the information out there, still reel investors in. So anyway, that's something I've been thinking about today.
It's an interesting point. I feel like, as you were speaking, something that just came to mind is like, again, like if someone's a smoker out there, all good, right? But like, we know that smoking is bad for you, but yet people still smoke. And so it's one of those things where it's like, it's an uncomfortable, maybe truth or reality we have to greet and meet.
Yeah.
And like really kind of look at ourselves in the mirror. I mean, I keep talking about this. What are you doing? What am I doing? Like as an investor, why are we doing this? And if we can't clearly define that, then we're going to continue to chase these yield traps. Like if you realize that you have one body, right? Like you're a fitness guy, Ron. You have one body. You get one shot at this thing called life. Like you're either going to eat healthy, go to the gym, treat it like a temple, so to speak, or you're just not, right? And you're just going to let it kind of like go to waste. And I feel like that's our investing, our time in the market opportunity. You're either going to chase the yield for the immediate gratification because you get this nice paycheck, or define yourself and what you're doing here. You get one shot.
Yeah, that's a great point, man. Go ahead. Sorry, I didn't mean to cut you off. My bad.
No, I mean, look, I just made another video the other day, like kind of about this. Like I'm really fueled up on this point because to your point, first of all, I'll be the first to admit it. I made the mistakes. So, Ron, I think you have too. It's like the only thing we're really trying to do here is share the journey. And now that we kind of see people falling to the same traps we've fallen to, it's like, please don't, like, please don't.
Yeah. I guess that's what it is, man. I guess it's easy to look at that stuff and be like, why would you invest in that? It seems so obvious. But everyone's on their own journey and everyone's at different stages of it. And so, yeah, that's something that I certainly have to keep in mind. And those, like you said, those are lessons that we've had to learn the hard way and probably will continue to as well. And you hit the nail right on the head. It really is like it's a guilty pleasure, and it is buying those companies is a guilty pleasure. It is an attempt to satisfy that immediate gratification, which, you never really can, but that's really what it is. And as investors, there's so many instances like that where we have to we really have to fight against our own human nature and our own shortcomings as human beings that are just these things that are just hardwired into us. And it's tough, man. That's definitely one of the toughest parts about investing. But kind of like, tying it back to fitness, in both cases, whether it's investing or fitness, it really is like, when you get to the root of it, it really is about sacrificing today for the betterment of tomorrow. And so when it comes to doing things just to satisfy an immediate gratification or doing things today, it's investors, keep in mind it can be kind of a short-sighted approach to this whole thing. When thinking about the decisions that you make, not only in your portfolio but outside of it as well in other realms, think about how that decision today is going to impact you 5 years down the road, 10 years down the road, 20 years down the road. Certainly here in investing, that's really what it's all about. And that's kind of the tough thing too. It's hard to put yourself in the shoes of your future self in that period of time down the road. It's hard to look forward 20 years and make a decision today based on what that might look like, because that's such a long ways out, and so much can happen between now and then. And patience certainly plays a role in this as well, in terms of seeking that immediate gratification. And that's just another thing that we have to fight against as human beings. So tying all that together, once again, sorry for the tangent on this. It just seemed really prevalent today for some reason or another. And so I felt like it was worth talking about and worth reiterating. I'm sure we probably will throughout the rest of our lives reiterate it 100 more times, because it's just one of those things about human nature that doesn't change. And sorry if any of that came across as harsh or judgmental.
Look,
at all,
it's a reality though.
Wasn't what I was trying to do.
I think if any of the the Wall Street sages, maybe watched our YouTube videos, maybe some of them are. I don't know. Right? Chances are not, though. Right? Wishful thinking.
Yeah.
What would
you never know.
What would they share with us?
You never know, man.
You got Buffett like clicking away, like
T-bone.
retiring with Ryne.
Yeah. Have you heard
the
that?
real keys to success behind Buffett's victories?
Yeah, absolutely. There you go. Yeah, but that's the crazy thing. You never know who's on the other end. Go ahead.
What would these Wall Street sages like? In my mind, I know even right now, like I'm still learning. I'm a student, really, a year of life in the game of investing, and like that's. I think where it gets really dangerous is when we think we actually know definitively. Like when I love the comments that people are like, no, you're wrong and I'm right. And I'm like, maybe you are right, but maybe you're wrong. Maybe I'm in a different financial situation.
Yeah.
And it's like, again, like define, let's use definitions. I feel like we pull away from like defining that. Like I love the comments that I get when people are like, I just had one today. I'm 13 years away from retiring. Okay, that tells me information right off the bat. You're elder in your years. You are literally 13 years away. So what type of stock should I be looking into? Well, then that's a very different stock from the young buck in his early 20s. And I think that's the most important thing. Like these no-nonsense comments that are just like, yeah, go, all in on Yield Max or the ones you mentioned, some of these REITs, just because it has a 6% dividend yield plus. It's like, well, who are you? Like, first, let's set the definitions here.
Yeah, I mean, even in those instances, actually, no, I won't even say that. I want to go back to what you said a moment ago. We do sometimes think we have these definitive answers, and this is going to tie in. I'm actually really glad you brought this up, because this ties into something that you talked about today in the video you put out today. And coincidentally, I'm actually talking about it tomorrow in a video that I'm putting out.
Go.
But you talked about this. You talked about the idea of buying and holding stocks forever. especially when it comes to what we do, buying stocks to collect passive income and being long-term investors. We always buy with the intent to invest in a stock with the intent to just keep it for the rest of our lives, just to continue collecting that growing passive income stream. That's the goal, and that would be the most ideal situation with all of our investments. And so, as Warren Buffett says, our favorite holding period is forever. And it's true, but that's not always the reality of the situation. There might be some stocks in your portfolio that you have today that you will continue to have 60 years down the road, if you're kind of in our around our age or in our stage of the game. But a lot of them probably not. Even if you buy today with the intent to hold on to them for the rest of your life, you also, you can't necessarily get married to the idea that you can't force yourself to hold on to them forever. And I think part of prudent investing and good investing is knowing when to reevaluate those positions and to be able to. And we kind of talked about this last week, kind of having this sort of, I don't want to say an emotional attachment to our holdings, but we do. We have an affinity for the things that we own, partly because it's ours and we own it. So we attach a higher worth to it just because of that. But at the same time, we should, once again, know when to reevaluate and know when maybe the story has changed for those companies. And that's tough.
Even our story.
Yeah.
Has your individual story changed at all? I can tell you my story has changed immensely just over the last year. And it's almost like, I'll open up. I got sober 7 years ago. And what a trip of a journey. But what I've learned was I look around and I help a lot of guys out in terms of anxiety, depression, addictions, everything, the whole nine. And people sometimes go stir crazy at year 3, 5, and 10 and whatever, and because they're doing the same thing that they were doing in their first 90 days or 1 year. And I'm like, if you're not learning and growing, then there's no point for you to kind of be here. You're just still going to go insane. And so my point here is if you're an investor who started investing at age, call it 20, and now you're 20 years down the road and your investment strategy has remained the same, you haven't learned anything, you haven't, evaluated yourself, you haven't looked at your needs, your goals. What are you doing? You're going to find yourself with this portfolio going stir crazy. And then saying, I think, some pretty outrageous things. I know the answer, and this is the golden opportunity that, Ryne, you need to buy. It's you're in an entirely different position,
Yeah, that's true. That's true.
You need to learn and grow, and it's a dance. It literally is a dance. Just keep growing and learning, and that's why I don't get these people who are so stuck on their strategy, on their way. It doesn't make sense. I love dividend investing, but over the years now, it's I really come to understand that for myself, I also appreciate some growth stock opportunities, and I'm not afraid at this point to say, you know what, dividend investing with some higher yielding dividend stocks, the maybe 2.5, 3+% dividend yield stocks, kept me comfortable and warm throughout the years. But now I'm ready to go out there and still look for quality stock opportunities, ideally that do pay a dividend. But I'm not afraid of the Visas and United Healths of the world.
Yeah. Well, that kind of goes back to what I was saying a few minutes ago. It's buying into those stocks would be a decision that you're making today for 20 years down the road. Because it goes back to yield on cost. When it comes to dividend investing, it's not, and this is where the AG&C investors and the yield max investors, this is where they get tripped up, I think, because you're just looking at the yield today, but it's not about today. It's not at all. It's about down the road, man. It's like I said, it's a sacrifice today for the benefits of tomorrow. You're sacrificing that high yield today because 20 years down the road, if Visa just keeps doing its thing, if Visa continues to grow its dividend by, man, even I think the 5-year CAGR's 13 to 15%, somewhere in there. But man, yeah. So even if it grows 10% every year, 9-10% every year over the next couple of decades, it's like your yield on cost with that one position is going to be higher than your yield on cost with something like an AGNC, which, yes, maybe has like an 11 or 12 or 13%, maybe 15%, I don't know, dividend yield starting today. But once again, that dividend per share is going down over time. Your yield on cost is going down over time. So with Visa or UNH or Snap-on or Lowe's or any of these other great dividend growth stocks, while over time your yield on cost will go up, your yield on cost with any of these yield traps will go down. So, and that's just such a tough thing. Like I said, it's so hard for us to put ourselves in the shoes of our future selves, but you have to you have to do it, or else you'll continue to fall victim to these things that may sound good in the short term, but over the long term will ultimately come to hurt you. And I also want to touch on. Sorry, I'm off to the races now, man. We're in the ring of.
You came prepared today.
We're in the ring of fire, man. It's something in the coffee today. Maybe it's because I got my Snoop Dogg mug here. Maybe a little. I don't know. It has something to do with it. But another thing that you touched on that was so great is we always get these comments about how we're wrong, or not even about us. Let's not even make it about us. Generally speaking, people, everyone thinks they're right about a certain stock. When you go to buy a stock, there's someone on the other end who's selling it, thinking its best days are behind it, and both of you guys think that you're right. But the thing is, the stock market is a complex, dynamic system that is constantly changing. It is constantly evolving, and it is constantly in motion, and it's something that never ends. And so you can be right today about a stock, but you can be wrong tomorrow, and vice versa. You could be wrong and down on a position today, but 5, 10, 15 years from now, it could be a big winner for you. And oftentimes, I think when we get these comments, it's always in the context of like, oh, year to date, it's down X percent, or year to date, it's only up this percent, or in the last year, or in the last 3 years, or whatever. Pick some short-term time period. And every time I see that, whether it's in our comments or on Seeking Alpha, people in the comments, or wherever you get that type of response from people, or you see that, it's always like, but what is a year? Really, when you think about it, a year is just the amount of time it takes for the Earth to go around the sun. It has nothing to do with like a business and its operational performance. And I think it's a bit unfair to think if something's up a certain percent in a year or down a certain percent that immediately makes you right or wrong. Anyway, that's my tangent there. But look, all of these things seem to tie together.
To that point, let's just think like for a brief moment what's happened this past year. I mean, like, heck, in the last month, right? Like the last 2 weeks, how much has unfolded and like the course of history, right? Like, okay, elections, Trump's in now, right? Inflationary data came in pretty good, right? 2.6. Like, just, it's like you said, it's so dynamic. It's changing and evolving every day. And so when we're looking at a stock like this stock chart, okay, it's up by 13%, 20%, X percent on the year. It's so arbitrary. I mean, it doesn't mean anything. Okay, great. But let's get down to business, literally, on their financial statements, right? It's like, what are they really doing? I was just interviewing someone, I'm not going to drop the name yet, yesterday for Masters of the Market, and I was so excited.
Are his initials WB by chance?
It could be. No. Look, he was saying he was the president of 2 companies. Awesome guy. Now retired down there in Florida. And so intelligent. But what he was sharing was when you're investing, it's literally all about the company. That's it. And some days, when the market's reacting to some negative headline, it does not mean the company is tanking. It doesn't mean that they've, just plummeted into the depths of debt and they're not going to, right? Like, and he started going to town on Microsoft. He was like, what a steal of an opportunity it was weeks ago. And I had actually made a video about Microsoft as well. It's just one of those things where it's like, why are we so fixated on things that are sexy and not the things that matter?
That's a good question. I mean, I don't know. Why do you think that is?
What's coming to mind for me is Alex Hermosi saying it's the woman in the red dress, like, but it's,
Uh,
I think, and again, I don't know for sure. So I'd love to know even in the comments, like what people think about this, but
yeah.
I think it's that we have like the ego comes in and it's like, oh, I want to say that every month I'm bringing in $5,000 in dividend income. And the thing is, if your plan isn't to live off of your dividend income, then that really doesn't matter. Like it again, like I just want to circle back to it. Like what's your plan? What are you doing? And without
Yeah.
that map, like it's just everything you're doing really doesn't, it's not going to make a whole lot of sense. Like you can say your stats, like, oh, my portfolio returns X amount, I'm getting this amount in dividend income and all that. It's like, cool, but what do you like? What's the end goal? Tell me the end goal, and then I can applaud you on your efforts, because based on what you're currently doing, you're either going to achieve that or not. And the other thing that's coming to mind for me is just like, I think we're just not understanding what investing is even about. Like, is this about making money? Or is it like Warren Buffett's approach? Like, it's the love for understanding business and not even looking at the market on the day-to-day, right? Like, the market closes for 10 years.
Yeah.
Is the business still doing well, though? Like, that's the love of the game.
Yeah, so that's the mindset you have to go into it with these companies, right? Like if the market was to close for 10 years, would you feel comfortable owning it during that time? And yeah, I don't know.
Every company in my portfolio right now,
yeah, that's
I would want to be either the CEO or at least sit in the board and like let's talk about this business. Like, I'm excited about the business.
Yeah, I feel the same way. And
then you speak to some people and they're like, "No, I'm just invested in it because it's a money machine." I'm like, "But you've totally missed the point."
Yeah, I mean, that's one of the other things that's probably never going to change. It's so easy to think of stocks just as these 3-letter things that randomly go up and down in value, or just have an X% yield that pays you whatever dividend. But going back to your point, we have to remember that stock ownership is business ownership. And whether you're investing in a little tiki bar here in Las Vegas, or a laundromat in Chicago, or a publicly traded Fortune $500 company, not $500, publicly traded Fortune 500 company, all of the same rules apply. You have to look at things holistically, and you have to go into your investments with the mindset of trying to figure out if this thing you're looking at is going to be able to withstand the test of time, and if, once again, 10 years down the road or 20 years down the road, it's going to be in a better position than it is today, if it's going to be able to survive and thrive during that time through all of the various ups and downs. And, as they say, like, past performance obviously doesn't equal future returns, but I think it is helpful still to look into the past and see how businesses have performed during turbulent times. I think that can tell you a lot. And, excuse me. And so I do think it is important to revisit a company's history and look under the hood to see what has been going on, to try and gauge what might happen in similar situations in the future. But I don't know, and I guess that's kind of the fun part about this whole thing, and that's where the love of the game comes from. It's so much fun spending time like thinking about these things and having these conversations, which are not easy. And in a lot of ways, now we're in our second conversation doing this, but in a lot of ways, it's like just us thinking out loud here. And I think I can speak for both of us when I say it's really helpful to be able to bounce these ideas off of each other. And hopefully for you guys watching and listening, it's helpful too. And maybe some of these things are thoughts that you've had yourself. But yeah, it's super helpful to be able to have someone to share these thoughts with. And I think I'm kind of losing myself in my tangent here, but yeah, I'm totally losing myself. So I'll end it there and give you the floor
Look,
now, Ari.
I'll pick up the ball where you
Yeah.
left off there.
Thanks, man.
I truly like just speaking to you, like, obviously not on, on a chat here like this and just going to WhatsApp, right? And like checking in weekly. It really is helpful to have somebody who, number one, appreciates the game. Number two,
that's what it was.
loves the game. And number three, can actually kind of call you out, most importantly, call you out for what may or may not be flawed thinking. Or
Ari was
maybe a
cussing
different
at me
opinion.
big time before we went live, just really putting me through the ring of fire.
Going to town.
Really bad language. I
Well,
was surprised.
I was being on myself a little bit today because I'll be honest here. Like, I know I made some big claims last week, right? I was like, I'm selling Coca-Cola. I'm selling Realty. I'm out. And the thing is, I didn't do anything, honestly, this week so far. I did nothing because I think right now it's so turbulent. I mean, the market is skyrocketing. It's so emotional out there. Mm-hmm. And the stocks I actually wanted to sell out of, Coca-Cola and Realty Income, that are on the list to get the boot, they both dropped in the share price because of the data that came out, the news here. And then what's running up here are the stocks that I actually just invested into. United Health soared, Google was soaring, Amazon, and it's all exciting. And I was like, shoot, right? Like, I'm still holding these stocks, but I got to get on this call with Ryne. And I told everybody last week that I was going to sell, and I still hold them. And I'm like sitting with myself for a moment, and I was like, it's all good, dude. Like, this is no one else's portfolio but yours. And that's another thing I think when we get vulnerable. Again, the best comments are when people open up and they're vulnerable. Like, tell me who you are, what your portfolio is like. Don't hide anything. And I think that's the real attitude everyone should have. Like, me and you on this thing, I'm happy I have you to call me out. I'm happy we can bounce ideas like this off each other. And I think if you don't have that and you're going at this thing alone, you're almost doomed.
Yeah. It makes it a lot harder for sure. And, I think that's one of the really cool things about this entire community is we're all after the same thing here. We're all on the same. We all pretty much have the same end goal, right? It's to reach financial freedom. And as Russ would say, there's more than one way to get to financial heaven. So all of us might be doing it slightly differently. But we're all after the same thing here. And it's cool to have that in common with one another. And I think that I don't know. And this is obviously such a complex thing. And we're really just trying to figure this out the best way we can. And so it is helpful for sure to have not only just you and me talking, but everyone in the comments and the entire community jumping in and joining the conversation and sharing their insights as well. And dude, that's one of the really, really cool things about having a channel and being a part of this community is you get to interact with people from all stages in the journey. Like you were saying, you can have a 13-year-old kid who has reached out to you saying they just started investing or they're just getting going. On the other hand, you can have someone who's in their 80s who's been retired for however long and has been investing for 5 or 6 decades. And man, they have so much great insight and experience that you don't yet. So it's really cool to be in this position where you've got people helping to show you the way and share their experience, which you can then learn from, and then you can pass on to those who are maybe 1 or 2 steps behind you. It's just, man, what a time to be an investor. And that is like, we're spilling our guts here right now. And this is what I was going to say before I lost my place a few moments ago. It might seem like this is like, why would you want to think about these things? Why would you spend so much time thinking and trying to figure it out when you can just buy ETFs and not even have to worry about it? But it's like, man, this is fun. This is thinking about this stuff and talking about this stuff with you, Ari, and all of you guys in the community. This is fun. It's fun trying to tinker with this stuff and figure this stuff out. a lot of people don't feel that, which is a good thing there's ETFs for that. But like for us who enjoy thinking about this and find it interesting and fascinating, yeah, it's really cool to be able to do this. And that's, I don't know, it's just it's a fun thing. And that's why we buy the individual companies that we do. And that's why we spend so much time not even worrying, but thinking about this stuff and chewing on these ideas and trying to learn and evolve and be better, because it really is for the love of the game. And it's not for everyone. It might not be for you if you're watching. But I don't know. I guess that's, once again, there's more than one way to get to financial heaven, and that's the beauty of it. And we can all get there doing different things, different ways.
Look, it's like as you said, you could go the ETF route. Wouldn't it be so much easier? Like, I think about this all the time. Like, I don't know how much time you have, Ryne, and like during your days, but I'm sure they're packed, which is so much to do. It's like life. You have life to do, and then I'm like, oh, but I gotta attend to my brokerage account, and I gotta make these YouTube videos. I gotta do all that. And wouldn't it just be easier for me? And I've talked to, by the way, some of the people I've had on Masters of the Market. No, not the retail investors, the bigwigs on Wall Street. And sometimes I ask them when they're on, and I'm like, what do you invest into? And they're like, oh, the S&P. I'm like, oh, but you're selling these products, but like, if I gave you $10,000, what would you invest into? And they're like, the S&P. And it's like even just think about that for a moment. It'd be so much easier. But that also takes away really from, if you are truly someone who loves investing, not just trying to get rich. I mean, love investing, love the idea of business, owning a quality business for an extended period of time and being a part of that ownership, then this is for you.
Yeah. There's something that draws you to that. Once again, it's not for everyone. And last week we kind of compared investing to watch collecting, and I'm going to bring that back today. I think watch people that get this, or people who are not into watches, the argument against watches is like, why would you buy a watch or wear a watch when you've just got the time you can look at on your phone? But it's like, being into watches, which is something I randomly got into just like investing, I'm looking at this thing. I'm looking at this Seiko SNX S79, I think is the model. I'm looking at this thing, and there's just something about it that draws me to it and makes me want to wear it and bring it into my collection. There's just something about it that resonates with however I'm wired as a human being. And it's really the same thing with investing. When it comes to these individual companies, like, there's just something that draws you to them, and it's exciting, man. Like, there's so many, and I think maybe this is why we get excited about this stuff. There's thousands and thousands and thousands of businesses out there. Not all of them are great, right? Like, in fact, most of them, especially these days, like the longer that you invest, the more experience you have, the more you kind of realize there's really not that many really worthwhile investments. Like, the longer you do this, the smaller your investable universe will get. But that's what makes this so cool is when you kind of start to narrow things down. When you do finally find one that you look at and it's like, there's just something about this that's special. Whether it's a Visa, like in my case, a Visa, or a Rollins, or even a Clear Secure. I've gotten really excited about these companies recently, and you don't come across those that often, but when you do, it's like there's just nothing like it. When I first found out about Clear Secure from watching Russ's video, I knew the company, I didn't know it was public. But when I found out that it was public, I was like, oh my gosh, this is really interesting. From that point on, after watching that video, I probably spent the next 4 or 5 hours just going deep and learning as much as I can about the company. And I'm still learning about it, but it's like, dude, there was just something about that hit me like a ton of bricks. It's like, my goodness, I think there's something here. I think there really could be something here. And it's what makes it even more fun is when you find these companies that are so under the radar. Everyone's heard of the Microsofts. Everyone's heard of Coca-Cola. Everyone knows NVIDIA at this point. But when you find these hidden gems, these diamonds in the rough. It's like, that's cool. And when it ends up working out, and in our position, when you're able to share that and have it be good with the people in the community, it's like, dude, that's an even bigger one. We're all coming together on this thing and making money and learning about this company, and it's just so much fun to have that camaraderie and be able to do that. You know what I'm saying?
There's also a huge ROI factor in that. Like when you're doing the due diligence and you stumble across, a clear, secure, and you think you have this golden nugget opportunity. And if it is truly what it is, I mean, the ROI is insane, which kind of...
And the verdict's still out, right? Like the verdict's always going to be still out because it's a never end. It's an infinite game. But sorry, I just wanted to add that in there.
No, 100%. I mean, you're spot on. I think what's cool is like you can find the clear secures of the world. If you own, like, I kind of think about it like this. You literally, and I mentioned this in the video I made earlier today. It was just like you only have a certain amount of capital. So I don't want to say bet, but like bet wisely. Like, don't just throw money everywhere. Really find a business. Really find your clear secure, and look. Get excited about it. Understand it, research it, live it, be about it. Like, I have a question for you.
Real quick before you ask, this conversation better not jinx clear secure. I'm gonna be heated. And with that said, just sidebar. With that said, sidebar, guys. Important reminder: don't invest in companies just because Ryan buys it or Ari buys it. Always do your own homework. Always do your own due diligence, because we could very well be wrong about any of the things that we invest in or talk about. So I just want to put that disclaimer out there, and just needed to say that real quick. But sorry, Ari, what's your question?
I'll also say this. I think last week, if I'm not, I don't remember the comment 100%. I just remember someone commenting on Clear Secure, and they're like, oh, it's not a great opportunity. Like on the other end of that, when we mention stocks, we're always the first one to take the bullet of just like everybody's opinion. And to Ryan's point now, it's like, just do your own research. If we think one way, it doesn't really mean anything.
Yeah, and like I said, I could totally end up being wrong about this investment. It'll take a long time for that to play out and to get some clarity on that. But there's something about it that I really appreciate, And so I'm excited to see how it unfolds. And anyway, what's your question?
What company in your portfolio, like out of all the companies you're invested into, if you could have one of these CEOs give you a call and say, Ryan, I just saw your YouTube channel. You look like, you know the business inside and out. And I'm retiring. I'm retiring with Ryan. I'm stepping down. But can you fill my place? What business would you want to become the CEO of?
That's a really great question. I would say, let me narrow it down. It's got to be one that has no debt or like negative net debt, more cash than debt, just because I don't want to have to worry about that. I want to say Visa, but Visa it sounds simple in nature, but it is a very complex business. They have so much more going on besides just being a payment network. That's obviously their bread and butter, but they have so many different value-added services that they offer to their customers. And there's just so many different directions with that business. So maybe not that one. I'm trying to think of what's going to be, because I need something that's like super easy for me to understand. And I feel like I need to be confident about it. You know what I'm saying? Maybe, I think Rollins is one that I'm immediately drawn to.
I would so not expect that, man.
Yeah, pest control, it's pretty straightforward. I would say that's definitely up there. Let me look at my holdings real quick. Maybe that will help. Maybe Vici Properties would be up there too. I would say probably between those two. Starbucks could be, but oh man, you'd have to be willing to take some slings and arrows being the CEO of that company.
It's turning around. It looks like. I mean, the stock soared the other day.
Yeah, it briefly reached over $100 per share, but now it's kind of on the edge of that right now. I'm gonna just leave it. Well, Williams Sonoma I think would be there too. So let's narrow it down to three. Probably not in any particular order. Williams Sonoma, Rollins, and Rollins isn't in my portfolio, but sometimes in my mind I like to think it already is because it's inevitable.
You talk about it enough where I think it would be there.
Yeah, and then maybe Vici Properties. So, what about you, man? That's a really good question. That's a tough one.
I would literally never suspect Rollins or any of the. I was not expecting any of that. I'm happy I asked. I think for me, I would want to say, like you said, Visa, but then I'm pulled towards United Health. I mean, I'm really stoked about United Health rather recently. I just like to be in the business of being an insurance provider, healthcare provider in a country that it's nothing's changing, I don't think, in the United States. Big business is going to be big business. It's a lot of money. And this is just the way the cookie crumbles. But to that end, then I'm not. I also like how it's segmented with Optum Health and then United Healthcare. I think that's a beautiful business model. But I think for the sake of ease, and I think also just looking into the future, I think Google, or Alphabet rather, would be an epic company to be the CEO of. I mean, I like, first of all, they got a lot going on under the hood, but their biggest moneymaker just being plain old advertising. Like,
yeah,
I just think about, for example, and we're heading into the AI future. I mean, there's so much under this hood, but I'll stick to the advertising for this point. We're heading into a year where at least I think that businesses are going to come back to advertising and with a necessity to really jump the gun on advertising. And where are they going to go? You're going to go to the one place that everybody uses. You're going to go to Google. And then AI is only going to do one thing for advertising, which is, I think, make it better. And then you look at, I mean, talk about a clean balance sheet with Google. Like,
yeah,
it's unbelievable. I think it's the cleanest balance sheet I've ever seen. And that's like you. I want safety more than anything. Like, I'm not going to, I don't think Visa has a clean balance sheet, but definitely not as clean as an Alphabet.
Yeah, because I think Google has like no debt at all, right? And they just got a ton of cash.
They're just sitting on. I'm surprised that like Buffett never got invested into Google. Like Apple, he got into, but I would question why not Alphabet.
That's a good question because I think I mean, the big thing for him with Apple is that, and he compares it to like buying a car. I was actually talking to someone about this last night. When you buy a car, let's say you have a Ford, right? You're looking to go buy a new car. You're not necessarily going to be married to buying another Ford. You'd explore Kias or Hyundais or Toyotas or Dodges. You would look at other brands and Volkswagen. You would look at these other things and compare and contrast and try and find the best bang for your buck somewhere in there. You're not necessarily married to that brand of car. But when it comes to Apple, it's like, if you're an iPhone user, unless for some reason you really hate the iPhone, you're going to be sticking with that iPhone no matter what the price is at that time. If you need a new phone, you're going to go to the iPhone. Not only that, but you're already in that ecosystem. So you're going to buy the MacBook, you're going to buy the iPad, you're going to get the AirPods, you're going to get the watch. You know what I'm saying? So it's a very sticky product, sticky ecosystem. And the same thing is true with Google, I think.
I was going to say, you're not going to switch from Bing. You're not going to go to Google to Bing, or something like that.
Right. If you're used to Googling something, you're just going to stick with Google. And I actually think, I could be wrong about this, I actually think you're seeing a similar type of behavior when it comes to these like generative AI platforms. I don't know how much you've messed around with like ChatGPT or whatever Google's version of it is, but whichever one you use and start using, I think and whichever one you get used to, that's going to be the one that you stick with. It's going to be, I don't think you're going to switch around too much. The same is actually true when it comes to like Adobe products, at least in my experience. If you're using Photoshop, or I edit all my videos on Adobe Premiere, dude, I'm not going to go to Final Cut Pro. I'm not going to learn a whole new software. I'm going to stick with what I know. Another company that has this as well is Intuit. I think if you're using QuickBooks, if you're using TurboTax, unless you go and hire an accountant or a CPA to do your taxes like next year, you're going to be using TurboTax, especially because they can just input last year's and all previous year's information for you. So I think that that type of stickiness is what Buffett saw in Apple. And to your point, yeah, I'm surprised that he didn't see the same thing in Google. Maybe he did, but I don't know. Maybe I don't know. Maybe there was some other reason he didn't buy it.
When Google fell, I think like maybe 2 years ago now, but it really, I mean, it plummeted. And it was when they had that AI mix-up, actually. Like their AI just completely messed up, and everybody sold off the stock because, of course, Google was going to completely vanish, by the next day because of that mishap. Yeah. I went to town on Google, and I was like, oh, my goodness, like, how could I not? And at that point, it wasn't even a dividend stock. And I hesitated so much because it wasn't a dividend-paying stock. And then two things happened. Bill Ackman, who I really look up to as an investor, bought into Alphabet. It came out on his next filing that he bought Alphabet. And then Alphabet announced that they were paying a dividend. And I was like, oh, would you look at this? Like, it kind of the full circle for me. But I'm just surprised because I feel like Google has a wider moat than Apple in some sense. Like, I get it. Like, I'm also a big iPhone guy. iPhone, MacBook, everything. I don't have the Apple Watch, but if someone gave it to me, I'd love to wear it.
Yeah.
I'm kind of just thinking out loud here about this, where it's like, you're not saying, I'm going to Apple it. It's like you're Googling it. You're lit. Even if I use this phone, I'm using Google. I'm just always using it. And I'm just surprised that a guy like Buffett, talking about high quality companies at not even undervalued share prices, but even fair value. I wonder if Munger ever whispered into his ear and he was like, hey, do you see Alphabet?
Yeah. And maybe they just didn't understand it too. Maybe it was too over their heads, which is something they talked about a lot with technology companies. It's just typically been outside of their circle of competence. But Buffett was able to see that as, this strong consumer company. And he was only able to have that clarity from investing in things like Coca-Cola, where he saw something similar. People are Coke people. Coke
Sure.
people don't drink Pepsi. And so that was a lesson that I think he learned from Coca-Cola and also was able to apply to Apple. And, Google and Apple, while they're, in the same sector, they are, like, how they generate revenue is different too. Like I said, Apple's consumer company, they get their sales from people buying their products. Google, the customer, well, not the customer, but the people who use Google, they don't have to pay anything for it. So, and I'm speaking to your point here because I think that adds a certain moat to it as well. One thing that could keep people from using Google or buying a new iPhone is that it's too expensive. But you don't really have that problem with Google. Advertisers may not, during certain economic times, they may not want to spend for advertising. But at the same time, like with Google, its network effect and that competitive advantage just gets better over time because more and more people are not only using Google, but using YouTube and now using their AI, whatever their AI thing is. So the network, and the Visa is very similar in this way too. The more people that use it, the more valuable it gets. And that is, I don't know if Apple has that same competitive advantage, if they have that same network effect.
Well, you know what? As you were talking, I'm thinking about this. Every single year, you hear people complaining that the new iPhone is literally the same iPhone, just with like maybe a speck or two of something different, better camera by the slightest degree, right?
Yeah.
When's the last time you ever heard anything about Google? No one kvetches about Google.
That's a good word.
Yeah, right.
It sounds very Hebrew.
Yeah, it is super easy.
Okay.
Kafetching.
Yeah. Yeah, that's a good point. And that's good. Like it's maybe that means it's more, and this ties back to its strong network effect. It's more resilient to change. But the thing with the iPhone, maybe this is the point you're getting to, like with these new editions that come out, there doesn't seem to be much change between them. And instead of that being a good thing, that's kind of a bad thing, because then maybe people aren't going to be as inclined to upgrade, you know?
It's like what you said, like we're dependent then on sales of a product
Yeah.
versus being dependent on searches that you know are happening, and that's all you have to do is extend the opportunity for companies to advertise in the search. Somewhere where they need, I used to work at Yelp, and one of the things that, when I was selling ads, that people would always say, like, you call these small businesses or even enterprise businesses, and you jump on the phone and they're like, oh, I'm advertising on Google. And I'm like, no, that's great. You should be advertising there, but also just know that you have this Yelp page and that people are also looking here. But the point that I'm making is, like, if you're a company, you need to advertise, and the only job you should be doing, like when I speak to a business owner and they're like, I got a billboard. I'm like, well, good luck with that, Hank. Like, like, okay, one-off chance somebody's looking at your billboard. Then the second thing is, like, are they actually going to call you? Do they memorize the number? Like, how does, like very old school. Today, new school is it's all digital. People are searching for you. People are going to find you there. Like, you need to be in front of people versus this iPhone is 2 generations behind. And I'm probably, definitely not like the masses, but I don't find a need to go out there and buy another iPhone right now. And
Right.
I don't think I'm the only one. So I'm just saying, it's like I'd be that would be something I would love to sit with Buffett on and just be like, why not Alphabet? Like, did you overlook it? Did you just, like, because even when you say, like, he may not understand it, but how does he understand Apple? I mean, I feel like that's a much more complex company.
I would kind of think too that he would understand Google a bit more, because throughout a lot of Berkshire's history, they owned various publishers like the Washington Post and whatnot, which, that revenue is not only subscription based, but also advertising based. So I would think that he would get it based on that. But I don't know. That would be an interesting conversation to have. And maybe, like, when they finally came around to understanding it and considered it, it's just not a good value. There's so many factors that could play into it, right? And that's another thing. And you know what, Ari? I'm sure if you had that conversation with him, he'd be totally fine having missed out on Apple. I think he'd be totally
100%.
okay with it. And that's part of what comes with the territory of investing as well. There are two types of mistakes or errors that we investors can make. There's, and I might get this backwards, but there's type 1, type 2. One of them is an error of commission, which is basically things that we do that turn out to be wrong. So for our case, for investors' case, this would be buying a company and it ends up, like, going to zero, or we end up losing money on it, right? That's an error of commission. Something we did do, but it wasn't ultimately the outcome wasn't favorable. On the other hand, on the inverse of that, there are errors of omission. And these would be like Buffett in this Google example. It would be missing out on a good opportunity, not taking action on something, and having that thing, the outcome for that thing turned out to be favorable and you missed out on it. So those are the two types of mistakes or errors that we investors can make. And I'm actually I've read about this in a few different books. But most recently, this idea, and it'll pop up in a lot of, like, behavioral investing books. But most recently, I was reading about it in this book here, which is What I Learned About Investing from Darwin by Pulak Prasad. Really good book so far. But in this book, he goes through some numbers, and it shows that we will be much better off making less errors of commission than making less, like it's better to make less errors of commission than it is to make less errors of omission. So basically, if you miss out on some good investments, like it's okay because you didn't lose money. If you buy companies and you lose money on them, then that's going to have more of a detriment to your long-term returns than this other type of error. And this ties back to Buffett's #1 rule of investing. You know what that is?
Don't lose money.
Exactly. And that's why he
Followed
says
by
it.
rule number 2, which is
never forget rule number 1. And that's what he means by that. It's okay to miss out on good investments because there's always going to be another one right around the corner. That's also something he talks about when he refers to it as like a no strike game. You know, you can miss out on good investments and it's not going to hurt you. But if you invest in things that lose you money, that's, you know, you're going to be taking steps backwards in the pursuit of financial freedom. And that's like the worst thing that you can do. So as long as you're making money, like you're good.
Ryne, I'm going to spin this in a little bit of a different direction just because you brought this book up. I am a pretty voracious reader, and you are as well. But I always see on Instagram, like the books that where do you find your books? Like you always seem to have the most interesting books. And I'm like, I write them all down. Like the other one you were reading, what was it? The Liberal Arts of Investing?
Yeah. Investing, the Last Liberal Art.
You search Amazon, like where do you find the books? Where do you?
Yeah, all over, man. I mean, sure, Amazon. Like, so before I even get to that, I'll hear about him so many different ways. Like Russ is also a really big reader, and we'll talk about books a lot too. Like we'll talk about what we're reading, and oftentimes we're like reading the same book, coincidentally. And so we'll share book ideas back and forth, and that's how I find out about certain books. But I also find out about certain books. I follow a few like book pages on Instagram too, so I get ideas there.
Are they investing
through just listening
specific?
to? No, like let me see. There's actually I follow this. One of them's an actual publishing company. I think it's Penguin Books.
Penguin.
Whoever it is, they're the publisher for. Let me see if I can find these pages.
So like I swear, every time I see your Instagram and you're reading something, I'm like, wow, it looks like a great book, and I write it down. I have like a list of Ryne's books, and I'm like, and I'm just like, where do you find them? Like, where?
Yeah, so actually, the one I'm talking about is Portfolio Books. I don't know if you can see this here, if it'll focus. Portfolio Books. I know it's backwards on your guys' page, but they're a publisher. And then, you know, from there, I just find these other book pages, Books and Beers, Alex and Books, Blake Book Club. There's so many different there's so many different pages out there to learn about these things. I also find out about them from podcasts. Like I'll listen to a lot of podcasts, and they'll either reference books or they'll do interviews with the author. And then from there, I'll go to Amazon and I'll save it to my reading list. So this is basically just a list of books that I want to buy. And you know how Amazon works too. Like you go look at one book, it's going to say, oh, well, if you like this, then you might also enjoy all these other books. And so you can get ideas from there as well. But dude, I've got probably 30 books in my reading list right now. It's just, there's just not enough time. Not enough time. But you chip away at it little by little. And it makes a big difference too, man. Like, not only do I read these books, but I take extensive notes on these books. So kind of my process is as I'm reading, if there's a quote that jumps out to me for whatever reason, you know, just something about it like interesting, I'll write it down, and then I'll just log the note or log the quote in my Investor's Almanac, which is basically like my note-taking tool that I built. And so I'll log the quote in there, and then I'll expand on the quote. So I'll write about what does this mean? What was my takeaway from it? And like, how can this be applied in the context of investing? And I found that following that process has really helped a lot of this stuff sink in. The stuff that I'm reading, it really helps me retain it and understand it a lot better than if I were to just passively read it and not do anything beyond that. You know what I'm saying? So that has been a super helpful thing that I would recommend for any investor to do, whether it's reading books or listening to quarterly earnings calls, or going through annual reports, or even just whatever your stock research process looks like, or your learning process, whatever you do. Writing is such it takes time, but it's so worth it because it's going to help you learn so much faster, and it's going to help you retain all that information so much better. So I'd highly recommend it.
Sounds like a Jamie Dimon approach. He talks a lot about this. Like even Bezos wrote all of his shareholder letters. Jamie Dimon is huge on writing. This whole thing reminds me of just like I emphasize this, or at least I try to a lot. Become your own CEO of your life. Like don't rest on your laurels. Just like go on YouTube and search, Ari or Ryne or Russ or any investor out there. It's like, okay, yeah, we're doing a lot of work, the groundwork, right? But like ultimately, I mean, you just showed me a great book that's on my list, and now I got to go read it. Like I got to get to work, And it's like, I feel like that's another thing just investors of today aren't doing enough of. Like, it's not enough to just search the web for 30 minutes. Okay, stock to buy, and then add it to your watch list, and then buy it. It's like, It's not enough even okay, you just summarized a little bit of, a book you're reading. That's not enough to, like, we can't, why are we spark noting our life? Spark Note's even around anymore? I don't even know, but it literally is AI now.
Yeah. But that's
just crazy.
That's a great point, man. And this just ties back to the love of the game. I don't do it. You don't have to write things down. You don't. It takes time to do it. Why would you write something down? Why would you read when you can just buy ETFs, I guess, you know what I'm saying? But it's like, dude, because I love it so much. It's so much fun. And even beyond what happens in my portfolio, I get so much out of learning about all these things. And this ties, all of this stuff that we're just now talking about ties back to just becoming, wiser human beings. And tying that back to the book that you were talking about a moment ago, Investing: The Last Liberal Art, the whole premise of that book is that investing is a multidisciplinary approach. It's not just about finance and economics. You can pull ideas from any subject out there, any subject whatsoever, from psychology to philosophy to biology and physics. All of these different subjects, there are takeaways that you can apply to investing in life. And I think it was Charlie Munger said that, like, investing is also a subset of worldly wisdom. So, and it all ties together. When you're learning about these things outside of investing, you can tie it to your portfolio, but you could also, like, generally it's going to make you a more wise and human being. And Charlie said you kind of have a moral obligation to do that, because through your own self-education and application of that, that's how not only you level yourself up and put yourself in a better position, and that compounds on itself throughout time, right? In the same way that your finances compound, the wisdom and the things you learn along the way will compound as well, and you're able to connect more dots, and things will make more sense. But that's also how you leave the world a better place. All of these, hopefully this conversation is a good example of that, All of these things we're talking about, we've learned through our own experience and our own self-education, and we're trying to share that with all of you guys watching, and hopefully it's helpful. And hopefully by doing this on a consistent basis and having the discipline to continue learning, hopefully when all is said and done, when Ari and I will no longer here, hopefully some of this gibberish that we've spit out today will have had a positive impact on your life in some way, shape, or form, which hopefully then you can take and pass that along to your kids or your family members or your friends or any captive audience that you have. You know what I'm saying?
I know exactly what you're saying. I don't even want to add anything to that.
Just brain dump, dude.
It was too perfect. That was a perfect ending almost there.
Let's not end it yet. I do want to throw this out, talking about books. This is quick. Ari, being the voracious reader.
It better be more fire than what you just said now. You're
going to
leave the world a better place.
No, man. I want to throw this out there. I mean, if there's any of you guys in the audience listening still, an hour and 4 minutes into this, Being the voracious readers that we both are, maybe there's room to do a book club or something. Maybe there's more that we can do here, because I know you and I both find this activity helpful. I know others do as well. And in the same way that having these conversations will be a game changer, maybe something like that would be as well. So I don't know. Maybe that's something we talk about at some point.
Again, whoever is still listening, 1 hour and 4 minutes in or 5 minutes now, the only reason Ryne and I are back on here now is because we saw the flood of comments that came in that said, hey, that was really neat, interesting, or quite an experience to kind of sit in on a coffee chat. And it's just two guys, opening up, speaking honestly about experiences that we've had. And I think that's, the more people we have participating in this, the more likelihood we'll all grow as investors. And I think that in of itself, whether it's the book club, which was awesome when I ran it, I'd love to do that again with a bunch of people. Or if it's just these chats that are ongoing, it's like the power of, a group.
Yeah.
The power of more minds working together. Before we close out, I want to ask, I got two questions for you. Do you have anything you're buying this week or that you already bought? That's question one. And then, because we're going to meet next week, what are you going to commit to between today and the time we get back on next week?
So this week I picked up some more shares of Clear Secure. I think I'm up to 66 shares right now, I think. Working on getting to that 100. So that's what I bought this week. And I also want to hear your responses to these two. To answer the second question, man, I'm going to commit to... What can I commit to? There's no big moves in my portfolio that I plan to make, so I don't want to commit to anything there. And maybe I'm tooting my own horn a little bit by saying this, but man, I've been really disciplined about reading and writing, not just when it comes to books, but I've been in the middle of going through all of the Berkshire Hathaway annual shareholder letters, which, by the way, guys, those are all free. You can find them online if you just Google that, Berkshire Hathaway annual shareholder letters. They're actually all on the Berkshire Hathaway website, going all the way back to 1977, I believe. So I've been going through all of those letters and taking notes on them. Last week I did 1990. Today, actually, I just published on my website 1991. So what I will commit to is doing one more of those. And I'm also trying to go through all of the quarterly earnings calls from the companies in my portfolio. And I've got 5 left to do. I'm going to commit to doing a few of those as well. I could probably get 2 or 3. I'm trying to do like 1 a day, but it's these last couple of days I've been off, just busy working on video stuff and newsletter stuff and just other miscellaneous tasks. But I would say that, I guess long story short, my commitments are just going to be to keep on doing the things that I'm already doing. I don't want to do anything super big, because I really think over time, man, and I know you'll agree with this too, it is those small changes, not those small changes, it is those small actions, it is those daily disciplines that will make the difference over time. So I'm just going to commit to staying true to that, and not only till next week, but like for the rest of my life, because that's really what it's all about.
Damn. That is the epitome of being a CEO of your own life. That is exactly what it looks like.
Well, you do it too, man. It's you do it too. And I think all of you guys out there watching are like this as well. You're all staying in tune with your holdings, with your portfolios, and what's going on. So just, guys, make that commitment with yourself to continue doing those things, because that's what's going to make a difference over a long term. Remember, guys, the things that you do today, delaying that gratification is a sacrifice today for the betterment of tomorrow. And so I would implore all of you guys to make that commitment with yourself, to not take the easy way out, and not always do the easy things. Sometimes do the hard things. Stop watching Stranger Things, which I just finished for the second time. Stop watching Stranger Things and pick up what I learned about investing from Darwin, or, whatever.
I'd love to have people comment even down below, like, what are you committing to? What are you committing to between today, right now, And next time Ryne and I jump back on. And
Yes.
also, what do you want to, like, if you have questions, I'd love for you to comment down below with like questions,
Yes.
topics of conversation. This can go anywhere. It's yours.
Absolutely, guys. And I think I don't want to get too ahead of ourselves, but I think we're pretty interested in making this like a regular recurring thing on a weekly basis. So let us know that you're down for that too, because that would be. I mean, I was very surprised at the good feedback that we got last week. So yeah, if you guys really like this and want us to keep it up, please let us know. But Ari, it's your turn, man. What are you buying, or what have
I
you
was
bought?
almost hoping
What is,
you were going to let
what
me
is your
go.
commitment? No ways. No way, man. You're in the ring of fire now.
I was like, all right, end, stop recording. Buys this week, I was having a bit of a tough time because I'm watching the market, I think, overreacting emotionally, and I hate buying during weeks like this or times like this. I haven't bought anything yet. I am remaining committed to a personal goal that I made, which is just literally to buy every single week, no matter what, at least, Monday through Friday, the S&P, just a share of VOO. So I know I will do that. Again, I really don't like where the market is right now, and just like this emotional period from post-election, which is totally normal. All of this is totally normal. But the post-election excitement, inflation being literally on point, like people are getting excited. People are still then curious to know what policy is going to look like. And this is all just to say I really don't like this week. And I wish I really doubled down or tripled down last week, but can't go back. I am watching, believe it or not, Microsoft, because I got about like $30,000 just sitting in my brokerage, not invested.
Oh my
and
God.
I don't know. I might, swing it, maybe swing trade this one because I'm not a Microsoft guy. That's the only reason. But I trust Microsoft, and I know Microsoft well enough to know it's going to be a safe play. Will I do it? Probably not. So I am watching it though. United Health fell back down. It's not near the price I'd like a buy-in. I think VOO and VGT might be I might snag a share of both of them come Friday. Commitment-wise, I really do. I mean, I have Coca-Cola and Realty Income at the top of my priority list to boot. And actually, the Masters of the Market chat, the guy that I had on, again, I don't want to share who it was yet, but he went as boldly as saying, you could go down to just 4 holdings in your portfolio. And I was like, ooh, I'm not going to do that, but I like where he was going with it. And if you listen to that chat, I mean, it might arouse some emotions for you. But it made me think, right? It's just like high conviction stocks. And so I do want to shed off some of the fat that I have. And I don't think Realty Income is a stock for me right now, just based on what I'm looking for and where I'm going. And so that's a priority. So if Realty Income pops back above 70, no, what was it? It wasn't at 70. What was it at?
It got to like the mid 60s recently.
Yeah. If it pops above and I'm green in all areas, strong ROI, then I will kick it. But I'm going to watch Realty Income, and likewise, Coca-Cola was above $71 per share, I believe, about a month back, and now it's down around 63. So the moment those are at I think, if I just get my ROI there, I'm going to get rid of them.
Yeah. Okay. Well, yeah.
I'm not going to make any like irrational moves.
Don't. Yeah. Do it when you feel the time is right.
Yeah. I mean, I'm like, I got nervous today because I'm like, wow, I really didn't. I'm a huge advocate for like, say what you mean what you say, and follow through. And then I was like, wow, last week I spoke such a big game on here, and like, I didn't even buy anything this week. I did nothing.
That's okay, man.
So I'm breathing, but I'm going to commit to, actually, Ryne, you got me on this because I was, I got so much going on in my life that I stopped reading as avidly as I was. And you were just like, dude, just go back to 20 minutes a day. And so today and yesterday, I actually just popped up in my alarm, and I just put 20 minutes and just reading.
Perfect. Keep you honest.
So that's
yeah.
what I'm committed to. Yeah.
That's great.
Accountability partner.
I love it, man. And dude, I think in a lot of ways that's what these conversations are. It's a good format to think out loud and sift through some of these themes that we're learning about. And we also, I think, push each other to be better, and having these conversations just naturally will do that. So yeah, I like that, man. Accountability partner for sure.
Love it.
I like it.
Investors, until next week.
We'll thank you guys so much for hanging out with us too. Last conversation was really good. This one might be the best one yet. So it was awesome. Thank you. Yeah, thank you guys for hanging out with us. It was fun.